Hey everybody, I'm Logan Alec. I'm a CPA. I own Choice Tax Relief. Today I'm answering a question about the IRS offer and compromise program. This question comes from Julie Sanning, 6677, who asks, can you make installment payments on an offer and compromise? I owe around $20,000 to $25,000. Great question, Julie. The answer is yes. You have up to 2 years, up to 24 months from the time the IRS accepts your offer to pay off your offer amount. Now, that being said, if you opt to take up to 24 months to pay off your offer, you may end up having to offer more to the IRS than if you could pay your offer amount in 5 months or less. This seems arbitrary, I know, but it's actually right on the IRS offer and compromise forms. And before I show you these forms and show you how these numbers work, let me remind you of the basic offer and compromise formula. If you've seen my video, offer and compromise formula, link at the top of the screen, you know this already, but for those of you who forgot or who haven't seen that video, the basic offer and compromise formula to calculate your reasonable collection potential, which is the amount of money that the IRS may accept in an offer and compromise, is the sum of your equity and assets calculated according to IRS rules, plus your monthly disposable income calculated according to IRS rules, multiplied by a future income multiplier. And if you can pay off your offer amount to the IRS in 5 months or less from the time the IRS accepts it, that future income multiplier is 12. If you need 6 to 24 months to pay your offer amount to the IRS, that future income multiplier is 24. And yes, these figures are right on IRS Form 433A OIC. This is the form on which you calculate your reasonable collection potential for offer and compromise purposes. In Section 3, you disclose your assets to the IRS and determine what your available equity and assets are for IRS offer and compromise purposes. When we get down to Section 7 really, where you disclose your monthly household income and expenses, that's where we calculate your disposable income here, what the IRS calls remaining monthly income. Okay, and then in the next section, Section 8, you calculate your minimum offer amount, okay, by adding your available equity, or not your available, just your equity and assets, right, which is this box, plus your monthly disposable income multiplied by one of the two future income multipliers in one of these boxes, okay? So let's just give an example here. Let's say that, Julie, let's say you have no equity in, let's say you have no equity in assets, right, for offer and compromise purposes, okay? So we don't have to worry about your assets. Let's say all you have is a minimal amount of cash in your bank account or something like that. Okay, so you have no asset component to your reasonable collection potential here. Okay, but let's say that the IRS, according to the IRS's math, right, which we're going to go through in Section 7 of 433 AOIC, according to IRS's math, let's say that after taking into account your monthly household income, less your allowable monthly household expenses, let's say you have $500 remaining every month. That's your monthly disposable income. Okay. If you will pay your offer in 5 or fewer payments within 5 months or less, multiply your remaining monthly income, that's this right here, the $500 that we just hypothetically calculated, by 12 to get future remaining income. Do not enter a number less than 0. So you'd enter 500. If you can pay your offer in 5 or fewer payments within 5 months or less, you put $500, the $500 disposable income here, multiply that by 12. That's $6,000. So you'd have 0 here because you have no equity in assets. You'd put $6,000 here because that's your monthly disposable income multiplied by 12, your future income multiplier. Your offer amount in this case would be $6,000. Now, if you can't pay your offer in 5 months or less, if you need up to 24 months, if you'll pay your offer in 6 to 24 months, multiply the remaining monthly income, the box F, okay, which we're saying, let's say, hypothetically is $500, by 24 to get your future remaining income, box H. Okay, so if you need 6 to 24 months to pay your offer amount, you put 500 here, times 24, that's 12,000, right? So zeros here, you have no equity in assets. You enter the amount from box H here, so that's 12,000, right? And $12,000 would be your offer amount. Okay. So the answer to your question, Julie, is yes. You can kind of get on it's not called an installment agreement. It's called a periodic payment offer and compromise, as opposed to the lump sum offer and compromise, right? But yes, you can stretch out your payments on an offer and compromise up to 24 months. That said, it may cause you to have to offer more to the government in an offer in compromise. Another kind of nit here is if the IRS looks at the $500 a month and it's the IRS is going to basically multiply that $500 a month by how many months you have left until your tax debt drops off, the CSED date, right? If you don't know what that is, check out my video, IRS statute of limitations on collections, link to that video at the top of the screen. And it's going to say, well, if that amount is $15,000 or something, it's not going to collect less. It's not going to accept less than that in offer and compromise, because what it's going to say is it would be in the best interest of the government to put Julie in a payment plan of $500 a month until the tax debt drops off, which we've established she can afford to pay, right? Because of this Section 7 here. It would be in her best interest, or the government's best interest, for her to just pay $500 a month, right, until her tax debt drops off. See what I'm saying? So they're going to actually, no matter, even if your offer amount here, the way the math works out, is less than that, they won't accept less than that in an offer. They'll reject it for not being in the best interest of the government. Okay, and that leads me to my next point, Julie, which is, if we're kind of speaking very loosely here and not, in technical terms at all. What I just described, the IRS looking at your $500 monthly disposable income and seeing, how many months left you have until your tax debt drops off, and multiplying that $500 towards the number of months until your CSED, that's in effect creating a partial payment installment agreement, which is an installment agreement that will not pay your entire debt off before it drops off. Okay. And this is not technical speak. This is not, don't run with this, but it's kind of like, if you can stay in that PPIA until the tax debt drops off, it's kind of like an offer and compromise on a payment plan, right? Because at the end of the day, let's say, the $500 a month for however many months, remaining until your tax debt drops off, right? Let's say it's 30. So that's $15,000, right? 500 months over 30 months is $15,000. On your $20,000 to $25,000 tax debt would result in the additional $5,000 to $10,000, Julie, that you have being written off, right? So in that sense, it's kind of like a settlement, kind of like an offer and compromise, in the sense that, hey, some of your tax debt gets written off. Now, a partial payment installment agreement at PPI does not have the finality of an offer and compromise. If you start making more money, Julie, and the IRS thinks, wow, Julie's monthly remaining income isn't $500 anymore, but we think it's like $1,000 or $1,500, right? Because now she's making more money or something like this. They can revisit that PPIA, right? They can do it every 2 years. Do they? No, not always, but they can, okay? And then you may be back to having to pay back the full amount of debt because the IRS has determined that now you have the wherewithal to do so before the tax debt drops off. This is different than an offer and compromise, which, there's an element of finality there. And I actually made a video recently about, can the IRS take back an offer and compromise if your financial situation improves after the IRS accepts the offer? And the answer there is generally no. Now, if the IRS discovered that you fraudulently submitted your offer, that you were actually the beneficiary of a trust or something that's about to pay out money, and you didn't disclose that on your offer because they asked that question, maybe the IRS would have a leg to stand on there. But if you simply come into some windfall that you have no way of knowing about, beforehand, or you start making more money, you got a promotion or something, that's fair game for you, the taxpayer. IRS can't go and take that back. PPIA, they could revisit the arrangement, okay, because it doesn't have the finality of an offer in compromise. Link to that video, about the finality of an offer in compromise is over here, and a link to my video or my playlist on all my offer in compromise videos is there at the bottom left-hand corner of the screen. If you would like to speak to us at Choice Tax Relief, give us a call, 866-8000-TAX. If you owe at least $10,000 in back taxes, you qualify for a free consultation. Or you can go to choicetaxrelief.com, fill out the form on our website, and we will get back to you. Thank you so much, everybody, for watching. I'll see you in the next video. Bye-bye.